There is a story by parents, reinforced by society, and advertised everywhere by banks and real estate agents. The story goes like this. Renting is throwing money away, and buying a home is the smartest investment you can make. For decades, this idea has been treated like financial common sense. If you rent, you're wasting money. If you buy, you're building wealth. Because of that belief, millions of people rush to buy homes as soon as they can. They stretch their budgets, take on massive debt, and lock themselves into 30-year mortgages, all because they believe they are making a smart financial decision. But what if the math tells a very different story? What if, in many situations, renting is actually the better financial move? What if the belief that rent is throwing money away is one of the most expensive myths in modern personal finance? To understand this, we need to change the way we think about housing, because the real question is not simply whether you own a house. The real question is, what is the true cost of living in that house? When people talk about renting, the downside seems obvious. You pay your landlord every month, and the money disappears forever. You don't build equity, you don't own the property. That's why people say renting is wasteful. But here's what most people never realize. When you own a home, a huge portion of your housing costs also disappears forever. Money that never comes back. Money that builds zero equity. In finance, these are called unrecoverable costs. And once you understand them, the entire rent versus buy debate starts to look very different. The biggest one is mortgage interest. When you take out a 30-year mortgage, most of your early payments do not go toward the house, they go to the bank. In the first years of the loan, roughly 70 to 80% of your monthly payment is interest. Imagine paying $3,000 a month for your home and only a few $100s actually reduce the loan balance. The rest goes straight to the bank. You're not paying yourself. You're paying for the privilege of borrowing money. Then there are property taxes. Even if you fully own the house, you still pay taxes every year. In a way, it's like paying rent to the government. Next comes maintenance. Every homeowner eventually learns this lesson. Houses break. Water heaters fail. Roofs leak. Pipes burst. A common rule of thumb is that maintenance costs about 1 to 2% of a home's value every year. For a $500,000 home, that could be $5,000 to $10,000 annually. Then there's insurance, another expense that homeowners must pay every year. In many places, insurance premiums have been rising rapidly. Finally, there are transaction costs. Buying and selling property is expensive. Real estate commissions, legal fees, closing costs. Together, these can easily reach 8 to 10% of the property's value. When you add everything together, interest, taxes, maintenance, insurance, and fees, the numbers start to look very different. In many cases, the unrecoverable cost of owning a home is surprisingly close to the cost of renting, which means you're not avoiding wasted money. You're simply paying it to different landlords, the bank, the government, the insurance company, and the repair shop. So how do you actually decide whether renting or buying makes sense? There is one number that simplifies the entire decision. It's called the price-to-rent ratio. You calculate it by dividing the price of a home by the annual cost of renting a similar property. Historically, a ratio below 15 tends to favor buying. A ratio above 20 often favors renting. And in many major cities today, the ratio has climbed far above that level. In places like San Francisco, Toronto, or Sydney, the math often points strongly towards renting. But the biggest hidden cost of buying a home is the down payment. To buy a $500,000 home, you might need $100,000 up front. That money becomes locked inside the house. It can't easily be used. It can't be diversified. It produces no income. In finance, this is called opportunity cost, because that same money could have been invested elsewhere. Historically, the stock market has returned about 10% per year over the long term. Over decades, that growth can become incredibly powerful.
Some people follow a strategy called rent and invest the difference. Instead of putting all their money into a house, they invest the savings each month. Over time, that investment portfolio can grow into something very large, sometimes even larger than the value of the home itself. But money isn't the only factor. There's also flexibility. A house can act like an anchor. It ties you to one place. A renter who gets a better job opportunity in another city can move within weeks. A homeowner often cannot move so easily. Selling a home can take months and cost a lot of money. Renting gives you mobility, and in a rapidly changing world, mobility has real financial value. Of course, buying a home can still make sense in certain situations, but the key point is that it is not automatically the best financial decision. Because wealth is not built by simply owning property. Wealth is built by owning income-producing assets, assets that pay you, assets that grow over time. Because there's a big difference between the two. An investment puts money into your pocket. A house often takes money out of it. So before you rush to buy a home, run the numbers carefully, look at the real costs. And remember this, sometimes the smartest financial decision is simply to rent and invest the difference.